Hey guys, and I'm very happy today to talk about a finance series. Actually, throughout this series, I'm just going to be talking about part of this MBA program stuff, but it's pretty basic, even for me. Basically, it is an introductory course to finance. Um, whole slide and the whole course is actually assembled by Professor Andrew Lo he's originally from Hong Kong, and he went to Taiwan when he was young and migrated to the United States when he was 5 years old. And Professor Andrew Lo, which I believe is one of the best professors in MIT Sloan School of Management. The first lecture, which is today, we're just going to talk about introduction and course overview. Here we start now. Today's lesson will be broken down into these following parts. We'll start with some motivation, and we'll go to some dramatic person A, and then we're going to discuss the fundamental challenges of finance, followed by the framework for financial analysis, and then we have to talk about the importance of time and risk. So 6 principles of finance and the course overview and how to get the most out of this course. So this course, which I'm discussing right now about finance, is actually it is more of introductory course to the finance subject. Therefore, it isn't that difficult, but isn't that easy as well. If you want to do some actual reading, it's really Mayers and Allen, chapter 1 and 2. Okay, and today we won't get to actually many mathematical parts today. We'll get to in the second lecture. Actually, I'm learning this course right now as well. From MIT OpenCourseWare. You can definitely check out their videos, but definitely I'm really happy and I really want to kind of develop myself, develop my knowledge through this knowledge transferring process by me teaching to you. I believe it is a great opportunity for me as well. More about this reading, I actually haven't started yet, but just want to share with you that professors at this most prominent universities actually value this book called Brilliant Mayers and Allen, which is Introduction and Principles to Corporate Finance, and many professors believe this book is particularly and extremely useful for students studying finance. And now let's get to the motivation part. And some prerequisites that when we finished all this critical concept, we might have to take more than 40 minutes. So that will be the length of this particular video. So the first part, motivation, what is finance? So finance, basically, it is mathematics plus money, because finance is math-based subject, but what you're doing is you're not really using mathematics as a math student majoring maths, but you're actually talking about money. You're in charge, you're discussing, you're playing around with money when you learn finance. Therefore, I would say the principle of finance is actually mathematics plus money. You're applying mathematics to make money, financing your operations, paying out to your shareholders, maximizing the value of your company, making future project forecasting, as a range of different tasks that would be involved with the study of finance, and the cores are mathematics and money. And many people, or you guys, may have studied microeconomics, and actually finance is about microeconomics without money, without time and risk, I would say. Not without money, but without time and risk, which we'll actually get to in a second, talking about the importance of time and risk in financial management. But actually, if you guys have studied microeconomics or planning to major in either finance or ecoms, my equation for finance, my second equation is actually finance equal to microeconomics without time and risk. But however, definitely in microeconomics, you study more about how, as a nation, should allocate its limited resources to maximize its value across all industries and its population. But finance is based, although finance and economics are quite different in many aspects, but they actually play around with the same principles. But economics doesn't play around time and risk. They do not really take into account risk and time when you learn about this microeconomic series, because in finance, time and risk are actually the core factors affecting many elements in financial management, which we'll actually get to in a second. And I want to start with some motivation, but I know the photographs are removed due to copyright issues, that I want to introduce 3 different people to you. So let me look at my notes, sorry about that. So I'm introducing 3 different people to you. The first person is James Simon, and the second person is Jack Welch, and the third person is Warren Buffett. So I'm introducing these 3 different famous persons. You may know or may not, but I actually think you may know 2 of these 3 persons. You might not know all 3 of them, but definitely 3 of them are of utmost importance in learning in the field of finance. So first, James Simons, I think if you're American, you know him better. He founded Renaissance Technology. But however, when James Simon wasn't the founder and CEO of Renaissance Technology, he was actually a professor of mathematics. So he is the first person we want to know in finance because he actually invented a series of mathematical models to be applied in the field of finance. For instance, the Chern-Simons model, which you can find out later, or you can check out the Bias, Myers, and Allen, and I think you can also find out as well. So James Simon is pretty successful. Actually, his take-home pay is $1.6 billion. That's his take-home pay, W2, not his net worth. So James Simon is a typical person in finance that actually applies mathematics. But however, I also want to introduce Jack Welch and Warren Buffett because sometimes finance is not only for those people who are strong in math. If you think you are not good at math and you want to give up finance, that's actually a pretty nonsense. That's a nonsense. Even though you have to work hard in math, but doesn't mean you need natural endowment in math in order to succeed in the field of finance. You don't really need that. So that's why I'm actually introducing Warren Buffett. So Warren Buffett, I think you know, is a major stock market magnate. He's a founder of Berkshire Hathaway, I think the most expensive stock in the world you can find. And Warren Buffett actually, even though he's successful, even though he's pretty smart, intelligent, he mainly uses two different statements, the balance sheet and income statement, to make financial decisions for Berkshire Hathaway. Which means Warren Buffett, despite he's popular, he's one of the richest men in the world, he's not even mathematically smart as James Simons. So the point I'm making here is in finance, different people, different successful people in the field of finance have different capabilities and different endowments, or different skills or different techniques that they apply. They don't have to be necessarily good at math. They don't have to necessarily be good at this financial statement. Many of them have interdisciplinary knowledge that they transfer, and many different prominent people in the field of finance have different knowledge compared to each other and different skills and capabilities. So Warren Buffett reads a lot. He actually reads a lot of simple accounting, but the things he does is not really simple. It's pretty difficult. That's why he makes $7 billion as his net worth. But however, he looks at simple accounting. He looks at income statement. He looks at the balance sheet. And yeah, that's how he makes some major decisions for Berkshire Hathaway. And the third person I want to introduce is Jack Welch. You may know him from General Electric. He is the CEO of General Electric. And Jack Welch is actually a man who got a degree in mechanical engineering. So he is a doctor. He got his bachelor degree, master degree, and PhD, all in this field called mechanical engineering. But however, he transferred the field of study. Even without a degree, he didn't get any degree like a bachelor or master or a PhD in finance. But he later transferred his field of knowledge to finance, and he's one of the most successful person in the field, as he actually made 4.5 times of the business revenue for General Electric within 20 years as his individual contribution. So an individual who actually times revenue by 4.5 within 20 years is actually amazing. That's a marvelous work. Impossible work, I would say. So he was a specialist in mechanical engineering, which honestly speaking has really no link to finance. Because in mechanical engineering, you don't really play with money. You don't really play with risk and time. You don't really think of this financial market, even though both of them are a technical subject. Both of them apply mathematics and maybe certain thinking models. But however, Jack Welch was able to transfer from the field and apply what he's learned in mechanical engineering. I think mainly the spirit, mainly the work ethics into learning finance, and he was actually able to succeed in the subject and actually contributed a lot to the revenues, earnings of General Electric. So this is my motivation to you by introducing these three different people. You guys may fit into these three different individuals, maybe with certain similar characteristics. And my motivation, the meaning, and the reason behind why I'm introducing this three different people within the field of finances to tell you guys that actually in finance, people have different backgrounds. People are involved actually originally in different fields. People have different capabilities. People have different inclinations. People have different tendencies, but they're still able to succeed in finance and creating the same or similar results. Therefore, you may be a math major, you may be a business major, you may be an engineering major, you may be a science major. There's no impossible saying you can't really succeed in the field of finance. There's no impossibility that you can't really work in the field of investment banking. Everybody's possible because finance is actually a pretty inclusive subject. It actually has multiple interdisciplinary connections across many subjects around the world in a university. So here are my motivations talking about James Simons, Jeff Welch, and Warren Buffett. I personally really like Warren Buffett, and I really suggest you to read a lot of stories about him. If I want to elaborate a little bit more, actually Berkshire Hathaway is a pretty large business, but Warren Buffett actually worked with a small amount of people, mainly him and Charlie Munger and a few other workers in Berkshire Hathaway in the top executive branch, because he is actually a simple man. He reads simple accounting, uses income statement, balance sheet. This is why what I say is finance is actually a challenging subject. There's a lot of mathematics involved, but sometimes if you know the tool, you get the fundamental tools, you know the fundamentals, you know how to read income statement, balance sheet, not the simple version, but the complex version, you know how to read it. You're able to actually use the tools particularly well, like Warren Buffett, then you are actually able to succeed in finance. Okay, let me continue. Okay, so now we start with our dramatics persona. So that was an introduction to this subject. However, mathematics plus money equal to finance doesn't mean finance minus money equal to mathematics. Even if it's true arithmetically, I don't really mean so. Okay, dramatics personnel. So actually, I'm introducing you the flow model of economy. That is basically the intro to finance. Everybody's supposed to know how this economy flows actually across the financial market. So remember to keep in mind one of the most important party in finance is actually financial intermediaries. There's investment bank. Financial intermediaries are especially important. There are these investment banks, there's primary dealers, these credit rating agencies, credit enhancers, and liquidity enhancers. I'll get to these definitions in a few lectures, maybe third or fourth lecture. But now, just focusing. Hope you guys actually understand the role of intermediaries. So we have the capital market. Households do invest in the capital market. Maybe your parents do. Maybe you do yourself. Maybe you know someone do it. Maybe your father's business do. Your mother's business do. So this household make investment into the capital market. There's also non-financial corporations making investment for their return. There's a labor market, which households use to make money. There's product market, where these firms sell their product and sell to the households to create value. So this flowchart is pretty easy, self-explanatory. Basically, I think you learn similar stuff for micro economics class, but basically about how product flow. People make money. People want to make investment. After investment, the company who got this investment want to finance their business operations, and they actually take the return back to the households who make the investment, back to those corporations who make this investment. So I know I'll put a slide link below, but I just talk this much for now. Okay, so now I'm introducing you the two fundamental challenges of finance that actually both of these challenges. If you figure out both of these challenges, you're done for finance class, because then you don't have any challenges. But these challenges are actually lifelong challenges that are fairly difficult, and sometimes you have to take a little bit risk or take a lot of risk. So the two fundamental challenges of finance are actually valuation of assets and management of assets. So in terms of valuation, you're thinking of real financial valuation. Sometimes you have tangible valuation, intangible valuation. So I want to talk a little bit more. Just think about asset. What do you mean by asset? I'm actually going to get to the definition of asset in the next lecture. This lecture, I'm still not introducing you what is asset in a financial point of view. But valuation of asset, asset can be something like a stock, can be something like a derivative product, can be like a bond, US Treasury bill, and also can be knowledge, right? Can be knowledge and your skill. If you measure the asset of this Huawei phone, it may be fairly simple and straightforward. But asset can also be reputation, can also be knowledge, and that will be classified under the so-called intangible asset. So it is pretty hard to evaluate. What do you mean by value is you actually know how much these assets are worth now in the future, and that is the hard part of valuation. If I value my Huawei phone, I don't have to play valuation. I can just check out the price from the Huawei website. This I think is like $700. That's it. However, you need the future valuation of asset when you are deciding to develop a project, develop a good or service that is going to be launched in the near future. And in that point of view, you actually need a lot of different skills. And it can be highly risky to do this valuation then. And it can be real valuation, it can be just a financial valuation, and afterwards, in this step called a management. To be honestly speaking, after valuation, if you're pretty sure about valuation, you grasp the value, you know this value pretty clear, you don't think there's any risk, management becomes easy. Which one is better, which one creates more money, earns more money, you just buy this asset. Isn't it? If you don't get this, please talk to me. Because everybody wants money, right? Okay, so business decisions involve valuation and management. So these are actually the two fundamental challenges, but they are pretty complex. Because in finance, people are really basically playing around valuation and management. And business decisions actually heavily involve valuations and management. You cannot actually manage what you cannot measure. And valuation is a starting point for management because when you do management, basically you try to allocate your resources, whether you're going to invest and go forward with this asset, or you say, oh no, I'm not going forward with this, I'm going forward with option B. Or maybe I'm doing a mixture of option A and option C. So these are the parts involved in the management aspect. However, management actually is a step that comes after you finish your valuation. Without valuation, you're not going to get to the management step. Impossible to get to the management step. Once the value is established, management becomes pretty easy. So that's why here's a formula written by Professor Andrew Lo, is that objective plus valuation equals to decisions. Once you have objective, like you want to choose finance a product with most reward, most return. Valuation, decide. I would say the first part, you know the value of the asset, then you can come up with a decision. That's how it works. However, valuation is generally independent of objectives because valuation it can be pretty actually should be pretty subjective because it depends on what data are you going to analyze. Maybe you want to take the data from the last 5 years. Maybe you want to take the data from the last 10 years. Maybe valuation you want to take the data from multiple market. What market are you going to take the data from? Which particular assets are you going to take the data from? And so it's pretty subjective. That is why even though valuation can be mathematical, but if you talk to math major students, they may know how does the equation work. They may be able to prove an equation. But in finance, not only you should know how to apply it, many people will have different ways to input the different numbers and use different methods in valuation. That is why finance involves risk, but mathematics and microecons don't involve really risk in your lectures, in your class, because in finance you talk about future. Accounting is a past. You know about the past with accounting. This is accounting. You know about the past. Going back. And finance is actually this. My right hand looking forward. Accounting is when I use the data from the past. I try to analyze data from the past to see how I can work out the future. But I'm also thinking about the future, the interest rate, inflation, there's bubbles, economic recessions, and this is the future. This is finance. If we talk about the window, this is actually the window roll mirror. If you talk about the car, this is a mirror that you look at the back. And this is your window that you look at forward. Finance is all about the future. How do you get the money to finance your business operation and expand your business in the future, looking forward? How are the money going to work today in the future? That is a time value of money, which I'll talk about involving the net present value. How money today, a dollar today, will work in the future. So we have a lot of considerations to take in this point of view. And the role of financial market is the price discovery process. And today I'm going to play with you a price discovery process. So how does it work? I would say, for instance, if I'm actually buying this book, I want to buy. So here's a book, and I tell you that I have something that you don't know in this book. I have certain object in this book with words maybe less than the book, maybe words larger than the book. I want you guys actually now to buy it. And what do you think? How much do you want to buy? How much are you willing to afford to buy this book in cash? So many people may say $2 because the book worth $2, but many people may say $10. because maybe there can be something valuable inside. Maybe there's a calculator inside. Maybe there's a USB inside. And in fact, what's inside is actually my phone. So in this case, actually the value of this book, which I didn't show then, is actually $752. This is $750. This is $2 from the local shop. This is Huawei phone. So sometimes, financial market, I don't want you guys to think the financial market as like a gamble, but the financial market is highly risky. So there's always this price discovery process that actually determines the interest rate of a particular asset. So, when I show you this book, you say, oh, maybe it's $2, maybe it's $10. Everybody's uncertain about what is inside. Nobody knows there is a Huawei phone inside. Nobody's going to bid about $700, even though that means they're actually earning a piece of money. Given that it is a real phone, I mean new phone rather than a second hand. However, there's always a price discovery process, and that is what actually determines the interest rate of the market. So if someone asks you, I know the professor, which I like this professor very much, Professor Andrew Lo, he questioned the student in this way that he always asks this question: how do you get interest rate for a particular asset? How do you get interest rate for a stock, for money, for auto loan, for mortgage loan? How do you get interest rate? You get from the market, because just now, my example here is actually the auction process. Some person may afford $2, some people may buy $10, some people may buy $100, and the market is also this price discovery process that actually the interest rate is determined by people auctioning. The person with the highest price determines interest rate. It is highly risky because if the book, rather than this, what if it is this? If someone buys $200 and gets this, the market will be panicking. But if somebody gets both of this, but buy $100, market is optimistic. That's how it works, basically. So that is my little example. I hope to do it with a class, but I can't really do it with a class because right now I don't have a class. Yeah, but if there's a class, I'm really willing to do buy AirPod or something to actually gamble it, to actually let the class auction it off to see how much are they willing to pay. So that is my example here. So that's about finance. So in finance, we actually don't know how much money we'll have, how much the interest rate is going to be, and that's why valuation is pretty difficult. How do you value this without seeing Huawei phone? You don't know whether it's a highlighter or a phone or a small pen. That's what makes finance particularly difficult. And my next part is the fundamental challenges of finance in terms of valuation and management. So, the fundamental challenges of valuation management. Now we have to elaborate a little bit more to ask ourselves what are these challenges in details. So first challenge is how are financial assets valued? We don't know the price, right? How are they valued? We know they're valued and determined somehow by the market, but how do we price certain financial asset? And how should financial assets be valued? After, how are they valued? How should they be valued? How do you apply the tools? We know the tools, we know the formulas, we know the data, but how should they be valued? What data should we choose? What formula are we going to use? What aspect of the market are we infusing or incorporating in this? Are we going to incorporate in this price valuing, asset valuing process? And how do financial markets determine asset values? How well do financial markets work? After we know valuation, after we finalize the value of certain assets, or maybe we price certain assets, we ask questions on management. How should I spend or save the money? Should I buy or sell? What should I buy or sell? When should I buy or sell? No, not only for financial intermediaries, no matter what you're investment banker or commercial banker, but just an individual investor, you have to ask this question pretty frequently. So when should you buy? When should you sell? At what price should I buy? At what price should I sell? Should I buy option? Should I buy a future? Which I'll get to in the later lectures. What are futures and options, swaps? When should I buy? When should I sell? And how should I finance this transaction? This is a good question for people working in investment banking division. And this applies to both personal and corporate financial decisions. For corporations, they may be doing merger and acquisition. When should I buy? When should I sell? They do an IPO. They are kind of working as dealers in the financial market. So they have to make decisions on when should I sell, when should I buy, how can I make the largest profit. And individuals who are investing, thinking about household, individual households, thinking about how much, how can I maximize the profit, how can risk management, how can I maintain risk management to reduce the risk while maximizing my risk-adjusted return for my household, for my parent, my child, for my children, for my wife, for my husband. This is the question to ask. Okay, now moving on to talking about introducing you to accounting. So accounting, which I talked about, accounting is actually facing back and finance is facing forward. But finance, even though it involves the future, but you have to have data from the past to help you make financial decisions, or data from yesterday, data from tomorrow to make the decisions. Therefore, we have to have this accounting, facing backwards, and this is crucial. This is indispensable accounting to finance who are looking forward. So, accounting is a language of finance, which we'll get to certain aspects of accounting in our lectures. Because accounting, even though we don't want to get it too deep, but accounting is a language of finance. It is a tool that actually will help us to understand finance. Therefore, in the coming lectures, I'm going to be discussing about accounting. So by the end of this course, you also get a little bit, you actually obtain certain knowledge and skills related to accounting as well. So if we analogize accounting to English, basically it is vocabulary, the syntax, the grammar, the poetry. Just now in my motivation, I talked about Warren Buffett, and I actually mentioned about him looking at simple accounting, looking at income statement, looking at the balance sheet, and these two financial matrices actually involve this language of accounting inside. It is a crucial part inside income statement and the balance sheet. And the stock, and also basic concept you have to be familiar in accounting. And also in accounting, we also talk about stock versus flow. Here, the stock, doesn't mean the stock that you trade, doesn't mean equity, but it actually means the level of knowledge you put in, the level of resources you put in, the stock pile. So stock and flow variables we'll get to a little bit second. So I want to make an example. Imagine a bathtub. This is my favorite example. Imagine a bathtub. Hopefully I'll see if I can show you. So imagine your mind a bathtub. The stock is actually the level of water. So it is the level of water in your bathtub. And the flow is how fast the water flows to the top. So it is basically a relationship of a function and its first derivative. So first, stock is in financing accounting is the level of different tools, different capabilities you are putting in, and how fast are they applied in finance. That is a flow. So the stock and flow, the level of water in your bathtub, and how fast the speed of water flowing into the bathtub, relationship between the function and its first derivative, are the principles of accounting. And the balance sheet, definitely. Balance sheet, if you don't know about, in a nutshell, it is basically a financial matrix introducing you to the balance sheet, basically the assets and liabilities of a particular business, a snapshot of the financial status quo. Basically, the flow is the level, how much assets does a company have, the fixed asset, variable assets, in terms of long-term assets, short-term assets, capital expenditures, like buildings, like, stock, warehouses, machineries, and these revenue expenditures, like human resources, what you're putting, the cost you're putting in to developing these skills, maybe components, a little bit manufacturing, daily requirements. These assets classified under capital revenue expenditure. An income statement, which you guys should be familiar right about. If you don't know, please read our Byers, Allen Mayers. Income statement is basically a sheet, financial matrix showing how much the company is earning, its profit, revenues, and cost, and also involving tax and dividends paid to the shareholders if your business is listed and IPO'd. So that is about the flow, because balance sheet tells you the level of the business, assets and liability. Income statement is how fast you're earning money. Like within a year, how much revenues did you have? How much profit are you generating? How much cost are you putting into your operations, into financing this particular year? And balance sheet is overall the level. So hopefully you get this idea, and please do more research, just the simple research, basic research on what is a balance sheet and what is an income statement if you're not sure about. But usually, high schoolers who take business courses or I would say econ courses should know these two financial methods. But you may not know it's completely okay. So the financial status, as I mentioned, I just want to reinforce and elaborate about is a balance sheet. How much liabilities, how much assets do you have, debt or equity finance? How much debt do you have? Debentures, overdraft, trade credit, bank loans, and financial decisions about the income statement are made based on the income statement. Okay, what about the rate of change Okay, so now assets and liabilities as what's involved in the balance sheet, what I want to just elaborate about. So assets can be cash. So we're earning, and maybe the cash can be from your machineries, from your inventories, your goods you produced, and capital. And sometimes assets can be intangible, like your knowledge and human labor skills. The skills to manufacture the products, the skill to manage an enterprise, the skill to coordinate the enterprise, the skill to make financial decisions, the skill to teach. Liabilities mainly broken down to equity and debt. So debt is something actually you have to pay back. But the person who is issuing your debt has no role in your company. Equity, which is the stock market, is when someone provides an investment. You don't have to pay back. It's a voluntary investment, but the person have to earn and have to obtain a certain cake of your company. So when your liability, when you're financed with equity, that means you're issuing stock to a particular person, but then the person is investing in your market, you get invest in your company, you get certain money from the stock market, but then they will own a little piece of the company. Income statement, pretty straightforward, basically about the profit, basically about your revenues, your cost. I don't want to go too deep about it, okay? So about your revenues, profit. So revenue deducts your cost, gives you the profit. But that's actually your gross profit because then you have to minus the fixed cost. For instance, rental cost, rental cost for warehouses, cost of machineries, and in the end, you have to also deduct the salaries of employees and the dividends you pay to the shareholder if you are a listed IPO public limited company. And in the end, you get a retained profit, also the taxation to the government, taxation and corporate tax, personal tax, land tax. In the end, the profit you deduct tax, shareholders, equity return, this rental fee, fixed cost, and then you get your retained profit. That's actually the pure profit you get. Okay, now getting a little bit complex is the framework of financial analysis. So looking at this diagram right here, hopefully you can see clearly, you are now understanding how does this corporate financial decision flow works. So read and understand, first is individual and institutional investors. In the simple words, individuals, personal investment, and corporate investment. Raise cash, and the financial manager invested into real assets. As a return, the cash generated by certain operations is given back to the financial manager, certain amount of it, and then the financial managers, the first step is number 4, to reinvest into this cash. To reinvest again, to expand the business, to expand the operations, and the cash return to the investors as well, because people invest, they expect to have a return. So it's pretty straightforward. You have 1, 2, 3, 4, 5. I will put a slide below so you can revise it afterwards. You can pause the video, take some notes as well. And in simple words, in the management framework, different jobs actually have different indices and different jobs involved in this corporate financial decision cycle. So 2 and 3 are real investment. 1 and 4 financing, basically getting this investment to the businesses, raising investment from the investors, and continuing this reinvestment process. 1 and 4 are basically financing, and payout basically focuses on paying, as financial managers paying the cash back to individual and institutional investors. And then the final objective is to create and maximize shareholder value. In this case, your company means your company is generating a lot of value. Then you're also maximizing this value to the shareholder, and hopefully they, as a consequence, will invest more to your business, and you have a larger proportion of money from equity finance to expand your operations. Okay, so I want to make it simple for you because this course is for finance, MBA beginners, the framework of financial analysis, breaking it down into your daily life, suiting your daily life. So for instance, shooting you to daily life 1005, same thing again, but now you are someone involved here. I mean, you are someone involved here, so you are the household. And people invest in the household, you generate economic activities. You may be a seller, you may be a hard labor, you may be a manager, someone working in any industry, maybe a teacher, maybe a painter. You are generating value and they pay you back, and you invest into these assets. That's about it. So definitely please look back at this diagram to see this example that actually suits your current situation. Okay. Don't want to go too deep about it. If we continue with it, basically financing is 1 to 4, and risk management is 1 to 5. As I mentioned just now, risk management, already mentioned it. Why is risk management 1 to 5? Because looking at this diagram right here, what you have to reduce the risk when people invest in a company to actually make sure you have generated enough return, maximize the return for shareholders. Also, when you pay back, you ensure that in this process, both parties actually win. Shareholders get return. You also are gaining money to finance your operations. So risk management is particularly important. Okay, moving on to time and risk. Two important factors that make finance challenging. As one of the most challenging subjects that you might see. This is why finance is on Wall Street, like in London, in the Isle of Dogs, in London Square Mile, you see finance in the best district because they make money. But making money comes with risk. Maybe you can make money, maybe you can't. That's why I'm introducing you to the two factors that actually are pretty important, intercorrelated with finance, that are time and risk. So in terms of time, cash flows today are different from cash flows in the future. Time flows in one direction, as far as we know. How should we model temporal differences is also a great question to know. Because as time, cash flow are actually different. Cash flow now are different from cash flow in the future. The value of cash flow now is different from the value of cash flow in the future, given inflation and the problem of impatience. If I borrow you some money, next year you have to give me more, because next year the opportunity cost is I can't spend $1 this year. So since I'm borrowing you $1 today, you are returning me $1 next year, I expect more than $1, maybe $1.10, with 10% of interest, maybe $1.30, 30 cents of interest. So that's why cash flow today are different from cash flow in the future. Therefore, there is this, cash flow, it's pretty, we have to value cash flow taking account of interest rate. In another word, RR, required rate of return. And risk, under perfect certainty, finance theory is complete. But we don't have this perfect certainty. Risk creates significant challenges. How should we model the unknown? How should we manage our risk? Again, this is a subjective question. It isn't objective. There's no single rule to help us model the risk, minimize the risk. It is always, what I say, pretty hard challenge. To address these two issues, we need the language of accounting. Accounting helps us with historical data, analyzing, finalizing, summarizing from our historical data. And then we apply mathematics. Math is an important tool in finance, using probability and statistics. And we challenge it, and we try to tackle challenges that can be can easily overwhelm current mathematical abilities. Okay, so course overview, basically introduction to talk about how will this course go. So this is our first section. So from our second lecture onward, how will we go? So today we finish our introduction. And and then we're going to go with valuation. In many lectures, since valuation and management are two challenges in finance, we're going to talk a lot about valuation. We'll start with mathematical concept of net present value, and eventually we're going to learn to price stocks, bonds, futures, forwards, and options to try to price this asset. Then we're trying to measure risk, manage risk, and reduce our risk. We're going to incorporate risk into valuation method as well. This is what we're going to be doing. In the final lecture, we're going to be talking about market efficiency. Putting it all together, think about, do financial market work while discovering prices? What about these behavioral biases in human psychology? how should finance theory be used in practice? Okay. So basically, this is all about lecture 1, because in this lecture, I've just been introducing you to finance. You learn about the challenges of finance, time and risk, how the model works, how the principal finance corporate finance decision process goes in the flow cycle. And I'll see you in the next lecture, and we'll actually start with net present value. How does the dollar today work in the future? How does the dollar in the future work today? Even though it can be a little bit easy, but net present value is a fundamental tool you need to have in order to understand all future concepts, whether in this course Financial Theory 1 or in Advanced Finance. Therefore, net present value is one of the most important tools that everybody learns in finance. Warren Buffett knows it, Jack Welch knows it, James Simon knows it. So every person with success in finance knows how to use these tools. And thank you very much today to attend first lecture, and next lecture we'll start with net present value calculation. We'll get to mathematics in finance. Thank you very much.